In our previous video, we explored 6 accounting scandals around the world and saw how red flags were often ignored. But these weren't the only companies hiding the truth. From the United States to Japan, the United Kingdom, South Africa, the Netherlands, and Singapore, more corporate giants misled investors with flashy growth. Let's look at 8 additional cases where the warnings were there all along. Enron transformed from a gas pipeline company into a Wall Street darling in the 1990s, hailed as an energy innovator with an unstoppable stock price. It was like walking through a house of mirrors, dazzling reflections but no real substance. In reality, Enron used complex off-balance sheet entities to hide billions in debt and inflate profits. Red flags included opaque disclosures, rising debt without matching cash flows, and unusually smooth earnings for such a volatile business. Consistent profits that don't match cash flows are often a warning sign. But across the Atlantic, another American giant was misleading investors in a different way. Tyco grew into a massive conglomerate in the 1990s, acquiring companies in healthcare, electronics, and security systems. Investors saw it as a global powerhouse. It was like using the company checkbook as your personal credit card while telling shareholders it was all legitimate. Executives looted hundreds of millions while disguising costs and inflating earnings. Red flags included suspicious executive perks, ballooning goodwill from acquisitions, and mismatched expenses versus cash flows. Personal perks disguised as business expenses are a red flag. Next, let's look at a family-run cable company that hid billions in debt. Adelphia, once America's 5th largest cable company, grew rapidly under the Regus family with new subscribers and acquisitions. It was like using your kid's piggy bank to pay your own mortgage and pretending the money was still there. The family hid over $2.3 billion in debt through related party transactions. Red flags included explosive debt without corresponding assets and unusual related party notes. Debt hidden in related party transactions is always suspicious. Across the Pacific, Japan's electronics giant Toshiba faced its own accounting scandal. Toshiba was a respected global electronics company, famous for innovation and household products. It was like turning up the volume on a broken radio to drown out the static. The problem didn't go away, it just got louder. For over 7 years, Toshiba inflated profits by more than $1.2 billion through deferred expenses and overstated project profits. Red flags included consistently high earnings compared to peers, delayed expense recognition, and vague reporting on long-term projects. Overstating profits under pressure from management is always a red flag. Meanwhile, in the United Kingdom, a construction giant was building on shaky foundations. Carillion was a construction and outsourcing giant, delivering roads, hospitals, and schools across the UK. It seemed like a stable blue-chip company. It was like building a skyscraper on a cracked foundation, impressive from the outside, but collapsing from within. Carillion used aggressive revenue recognition and hid debt off its balance sheet. Red flags included receivables that didn't convert to cash, ballooning off-balance sheet debt, and unrealistic profit margins. Revenue that doesn't convert into cash is a serious warning. In South Africa, a retail giant appeared equally unstoppable. Steinhoff was a furniture and retail conglomerate, often called the IKEA of Africa, expanding across Europe and Africa. It was like selling the same sofa twice, once to a real buyer and once to a phantom, to make numbers look better. Steinhoff inflated revenues and asset values through suspicious intercompany deals and fake transactions. Red flags included complex subsidiaries, revenue growth without cash flow, and sudden jumps in intangible assets. Fake intercompany transactions are a red flag investors should never ignore. Back in Europe, Royal Ahold supermarket empire was hiding profits in plain sight. Royal Ahold grew into a European retail powerhouse, operating supermarkets across the Netherlands, the US, and beyond. It was like counting the same shopping receipt twice to make your wallet look fuller. Ahold overstated revenues from supplier rebates in its US subsidiaries. Red flags included unusually high margins compared to peers, aggressive revenue recognition, and inconsistent disclosure in the notes. Supplier rebates and revenue recognition irregularities are always worth investigating. Finally, in Singapore, a jet fuel trading company hid massive losses. China Aviation Oil was Asia's largest jet fuel trader, critical to the region's airlines. It was like betting on every horse at the racetrack and hiding the losing tickets under the carpet. The company lost $550 million in risky derivatives trading but hid the losses in its financial statements. Red flags included unexplained derivatives positions, sudden swings in reported profits, and mismatched cash flows. Unexplained trading positions and mismatched cash flows are major red flags. 8 companies, across 6 countries and multiple industries, yet the same lesson applies. Enron, Tyco, Adelphia, Toshiba, Carillion, Steinhoff, Royal Ahold, and China Aviation Oil. 8 companies, different industries, different continents, but the same warning. Financial statements were sending alerts all along. Cash flows that didn't match profits, hidden or inflated debt, aggressive revenue recognition, and vague disclosures were the red flags. Always look beyond headline growth, the numbers tell the true story. Red flags never lie.